Okay, good morning. Today we are starting Chapter 7. We are going to do about half the chapter today. As you walked in, there were yellow sheets on a chair. Haley would be happy to bring you one if you want to raise your hand. Okay, she'll be around. Keep your hands up in the air for a while. Good to you. Okay, so if you're online, no worries. We're going to give you the URL in just a second. So what's due this week, starting with Saturday, we've got an attendance quiz due. That'll become available Thursday around 5, by 5. We have Chapter 7 homework. On Sunday, we do not have a video quiz because we have Exam 2 next week. Thank you, Haley. Okay. Video quiz 17 covers Chapter 8. It's due after the exam and after spring break. I would urge you, if you have the time, to go ahead and take video quiz 17 sometime before spring break so you don't forget. But it's there, so you can take it any time. Exam 2 is next week from Tuesday to Thursday. It starts at 8 a.m. unofficially, officially 9 a.m. on Tuesday, and it submits automatically no matter what at 9 p.m. on Thursday. Exam 2 covers Chapters 5, 6, and 7, and it ends right before the drop date. And if you're in Sections 5 or 6, you need to schedule with Proctor U at least 72 hours in advance, so you can be doing that. Okay, now moderating. I just want to make a general announcement. Brian's a grad assistant for the class, so he's been here all along. And with me today, and some days coming up, is Haley. This is Haley. Here, you can step in front and wave to the camera. Okay, this is Haley. She's going to be moderating some days. Thank you. And so she'll be here. She is doing tutoring, and I want to urge you to go to tutoring. We've changed some times around trying to attract more people. We've also had a problem with people signing up and then no one showing up. So if you sign up, you need to show up. And check your email. Under announcements in Blackboard, we email it and post it as an announcement. There's a link for signing up, and there's new times. We did Monday through Thursday, Monday through Thursday this week, different times. And then next week is our exam week, and we do have 2 one-hour sessions, one on Monday, one on Tuesday. I will send the sign up out Thursday for that this week. So we have 2 sessions next week, kind of like an exam review, sort of. Okay, Chapter 7, Learning Objectives. There are 8 in the chapter. We are only doing the first 5, and that's what the videos you would have done only did the first 5 as well. So we're not doing Learning Objectives 6, 7, or 8. There is a handout today, and that's what Haley was walking around with. Haley's put the URL in the chat window, so if you're online, you can grab it. It is a PDF document, and what we have here, if you're in class, we have a lot of questions this week because homework problems were either really, really massive and I didn't want to assign tons of homework, but I thought a better way to do the material is through the use of questions, and I didn't want your hand to fall off because I think we have lots of questions. So this handout is for today and for Thursday. We may not do every single question. I think we will do most of them. So we'll do a bunch, like we're going to start with 8 questions this morning, and then go into a homework problem and kind of flip back and forth. But the handout is there. It's not posted anywhere, and you will need the same handout on Thursday. So these are the questions we'll be doing today, so it should take away a lot of the writing time. I probably won't do this too many other times because we don't have this many questions in most chapters. The other thing I did want to point out is we have a review sheet. I think I put this up last week. I'll put it up again, but the URL for the exam review sheet is coming up. It's http://tiny.cc/review2FA. And this is through class is the only way you get the link for the review sheet. So we don't need the review sheet in class today. We're not doing anything with the review sheet. It's just there if you want it. And again, the handout is what we'll be using in class today. So as I said, we're going to start with a whole bunch of questions. We're actually going to do, I think, the first 8 if I recall. We're going to do the first 8, then we're going to do a homework problem. We're going to do a couple homework problems today, and we'll do some more questions as well. You'll notice as I put up the questions, you will see down at the bottom of the slide, it tells you what slide number it is on the handout. So as you look at the handout, there's a little number in the right-hand corner of each slide. That corresponds to what's on the screen, and the screen always shows you the URL for the question handout for today. Okay, so the first question, we have a lot of true-false questions. The cost of land may include the cost of any back property taxes that the purchaser pays. True or false? Brian, what's your breakdown on that? 16 true, 2 false, and the trues have it. When you go to buy land, when you buy real estate, if the person that owned it before you did not pay property taxes in prior years, that's added to the cost of land. You cannot transfer the land without paying back property taxes. So those back property taxes that you pay become part of the cost of land. Now if you're paying current property taxes, those don't become part of the cost of land. Only these back ones that you have to pay to be able to transfer the land. Next question, we have a series of true-false questions. The next one on slide 2. The cost of land includes the cost of fencing and paving, and it will show up. It is slide 2. Okay. Cost of land includes the cost of fencing and paving. If you want to click in, not brave enough to circle the answer. Yes. Yes. What do you have? 22 falses and 3 trues. That is absolutely correct. That is false. And the reason it's false is land is considered an asset that is indefinite, meaning it never wears out, it doesn't go away, so we don't ever depreciate land. On the other hand, fences wear out, paving needs to be redone, so those are subject to depreciation. So they go in a separate account called land improvements. And land improvements we do depreciate. Okay, next question. And I just answered the next question, so I'm going to go straight to the answer on the next one. So slide 3, I just finished saying it. Land improvements, this is worded weird anyway. Land improvements are not subject to depreciation. That is false, because what you can say is land improvements are subject to depreciation. So, okay? It's like using a double negative there. But we do depreciate. When we talk about depreciation, what we're doing is we're saying that we're taking the cost of this and spreading it over the whole life of that. So let's say we build a parking lot, and we build a parking lot, it costs us $10,000, and that parking lot's going to last for 5 years. So we don't want to take the $10,000 and put it in income or in expense this year because we're using it for 5 years. So we take the $10,000 cost of the parking lot, divide it by the 5 years, and we take a certain amount each year. And that's depreciation, spreading the cost of that asset over time. And today we're going to look at 3 different ways to do depreciation. Okay. Cost of land improvements are included in the land account. Again, this one I just talked about. Okay, the cost of land improvements are included in the land account. That is false. Land improvements are their own account because they are subject to depreciation, but land is not. Okay, next question, slide 5. Any cost to get machinery up and running and ready for its intended use should be part of the cost of the asset and depreciated. True or false? So this is the installation cost. This is if we have to wire it, we have to pay an engineer to come in and hook it up, we have to pay for a safety certification or anything like that to get that machinery up and running, ready for intended use. Should be part of the cost of the asset and depreciated. True or false? Haley, what do you have for a breakdown? 7 trues and 6 falses. Wow. And you're looking at it. Okay. Okay. Okay, and this one is true. Up until you've got that machinery running, everything you incur up to that point is part of the cost of that asset. If you want the chart on LIFO, FIFO, are you telling them to come to tutoring? Okay. Okay, so next question then. Okay. Company A purchased a used piece of equipment. All of the following costs should be included in the cost of the equipment except for, so this is slide 6 that's coming up. I'm going to qualify that. We don't know if they're the times yet, Haley. We think they are, but we're not sure. We're going to regroup and see how it goes this week. Yeah. If you want to know about tutoring times, go to the announcements on Blackboard. There's a sign-up link and it lists all the times. Do you have an answer on this one? D? Yeah, I think you could probably circle that. What do you have on this one? Okay, it is D. Okay, maintenance costs. Whatever costs you have after the machinery is up and running are not part of the cost of the machine. So the insurance, while the machine's being delivered to you, the sales tax paid on the machine, installation costs of the machine, those are all part of the cost of the equipment. However, once the equipment's up and running, those costs are not part of the cost of the equipment. Okay, slide 7. We have 2 more questions and then we're going to do a homework problem. Company B purchased some land and is preparing the land for a new building. Company B should include which of the following in the cost of the land? A, cost of driveways. B, cost of fencing. C, cost of sprinkler systems for the shrubbery. D, grading and clearing the land. Yeah, if you're online tutoring, I'm going to answer Haley. So just if you're online, we cannot do tutoring online. It's just not going to work. It's a very and that's part of the thing. If you're not here in person, you can't come in person for tutoring. So I believe there is tutoring for this class offered in the state of Ohio online, and you can use that service. But Haley's not doing tutoring online. Okay, what answers do you have for this one, Haley? Okay, a bunch of D's. Okay, and that is the answer. D, grading and clearing the land. Okay, when we're trying to put the land back to its original state, that is considered part of the cost of the land. These other items, driveways, fencing, sprinkler systems, those are all considered land improvements. And the big reason we want to put these in different accounts is land improvements are subject to depreciation. Land is never depreciated. We have one more question before we do the homework, and it's in the same vein. ABC Company purchased land with an old building that they planned on demolishing. So they bought this land, it happened to have an old building on it, and they're going to construct a new building. The cost of demolishing the building, the old building, will be part of the cost of what? The new building, the old building, land, or land improvement. Valerie online today? Okay, tell her I'm thinking about her. There you are. Yes, you know I'm talking to Amber, Valerie. Okay. Do you listen? You want to say C? That would be a good answer to say. What do you have? 10 C's, so the most popular answer is C, but there's still a bunch of other things. Okay, on this one, the answer is C. It is land. And the reason it's land is because demolishing the old building is part of getting the land back to its original state. Everything before, I like to think of it as everything before the shovel starts digging the foundation is part of the cost of land. So if you're clearing it, you're grading it, that's all part of the cost of land. But once you start with the shovel and start digging a new foundation, the digging, the expenses of digging become part of the cost of the new building. Okay, so that's why that's C. With that then, we're going to leave the questions. We'll come back to them in a little bit, but we're going to do homework exercise 7-4. You don't have this one. This is a homework problem. I just gave you questions, you know, that we normally answer, okay? So this is in your book. Short exercise 7-4. This is a good exercise in terms of going over all three depreciation methods. On that reference sheet for your exam, I would definitely have all three depreciation methods. We're going to do this one today, and I think we have one other homework problem similar to it. And between those two, I would know how to do these things. So this is a good one because it gives you an overview of a lot of different things to do with depreciation. Basically, in a nutshell, what we're doing here is we're going to do depreciation for 2 years. So year 1, year 2, we are going to do it under 3 different methods. Companies only use one method and stick with it, but we need to understand the 3 methods. And then we're going to compute something called book value. But basically what happens is at the beginning of 2011, a company purchased an aircraft at a cost of $44,400,000. They expect the plane to remain useful for 5 years or 6.5 million miles. Okay, so far so good. And then to have a residual value. Residual value is also known as salvage value. So residual value is salvage value. We can use those terms interchangeably. And what residual value is, or salvage value is it's how much we think that plane's going to be worth at the end of its useful life. So this company has said, we're buying this plane and it's going to be in service for us for 5 years. And at the end, so it's useful to us for 5 years. It just doesn't go poof at the end of 5 years though. It will instead, they can scrap it or sell it to someone else, and they're estimating that what they'll be able to get for it at the end of 5 years is $5,400,000. So that's what residual value is. It's an estimate of what we think it's going to be worth at the end of the useful life. Things may have a residual value of 0 or whatever dollar amount. If a problem doesn't say it has a residual value, then you can assume it's 0. Okay, then it tells us they expect to fly the plane 725,000 miles the first year, etc., etc. So that's the data for the problem. We are going to be doing their depreciation for the first 2 years using each of the 3 methods. And again, companies only pick one method, but we're going to do all 3 so we can see how they differ. So we're going to start with straight line depreciation for the first year. Straight line depreciation is the most common method. It's the easiest method. And something to note, we're doing it for the whole year. They purchased at the beginning of 2011 so we can take a whole year of depreciation. What we do for straight line depreciation is we take the original cost, the $44,400,000, subtract the residual value, and then we take that all and divide by the useful life. And that's how we get straight line depreciation. That $44,400,000 minus the $5,400,000, that has a particular term that applies to that. And that's referred to as the depreciable value or the depreciable cost. So depreciable value is the original cost less the residual value. Okay, now straight line. Straight line, like I said, is this easy method. What you're basically doing is saying, how much is this equipment or this aircraft costing me? I'm going to take that original cost, subtract out what I'm going to get for it at the end of 5 years. So that's really the expense of the airplane. Then we're saying, let's just spread that over the 5 years I'm going to use it. I'm going to spread it over evenly. That's all it's doing. Straight line depreciation will be the same amount of depreciation every year, every full year. So if you have a full year, your depreciation for straight line is going to be $7,800,000. So I can answer what the second year depreciation is already. I know it's $7,800,000. That's the 3rd year, 4th year, and 5th year. So that's straight line. Straight line is used by more companies than any other method, and it is the most straightforward. The big stumbling block to get over is to remember to subtract your residual value before you divide by the number of years. Next up is the units of production method. The units of production method, so this is a different way of computing it. I'm writing it down there. And I'm going to let you write that down, and then I'll talk about how we get that. Units of production. Let's talk about what we're doing here. Units of production. We said that the depreciable value is at $44,400,000 minus the $5,400,000. So that's how much we've got to depreciate. We're taking that, dividing it by the total number of miles we're going to fly this plane. So we get depreciation of $6 a mile. Units of production is an easy one to visualize because you say, okay, I've got the expense of buying the plane. I'm just going to spread it out over all the miles. And then I'll take my $6 per mile rate multiplied by how many miles I fly in a given year. So in year 1 it told us we were going to fly 725,000 miles times the $6. That's how we get the depreciation of $4,350,000. We can use units of production in only certain circumstances. Units of production method can only be used if we have an asset that we have some measure we can apply to using it up other than time, other than like number of years. So aircraft number of miles, when we have delivery vans, number of miles makes sense. Copy machines are usually rated for number of copies. The drum is rated for number of copies, so we could do number of copies for copy machines. For a lot of equipment, it's based on hours of usage. So we could do hours of equipment. However, if you have a building, it's really hard. How do you measure units of production for a building? What wears a building out that we can measure? Not really anything other than time. So units of production can only be used if we have some way to measure the usage of the equipment or asset, whatever it is. So that's units of production, 4,350,000. So then we go on to the last method. And the last method is the one that usually gives people a little more challenge than the first two. The double declining balance method. First thing we need to do with that is figure out our factor or our rate. And our rate is always going to be 2 divided by the number of years in the life. We have 5-year aircraft life, so it's always going to be 2 divided by the life, in this case 5, so we have a factor of 40%. We have this factor, and what we do with that factor then is we're going to take, this is the one that's different, we're going to just take the original cost times the factor for the first year. So we're going to take that original cost, this is for year 1 only. We're going to do year 2 in a few minutes. So 44,400,000 times the factor of 40% gives us the depreciation for the first year under double declining balance method. It says to do the depreciation for the first 2 years. We're doing year 1 now, and that's why I've got in orange letters first year depreciation. We're going to be doing the second year in a few minutes, but I'm doing first year first, then second year. So we will be doing the second year. Double declining balance method, note that this is the method that doesn't take into account residual value in these early years. You do not subtract residual value. Okay, back to the, you're taking care of audio questions. Will you deal with that? Okay, the 2 is always going to be a 2. The 2 relates to double declining balance method. So that note that I have at the bottom that says always 2, that will always be 2 because it's a double, it's twice the straight line rate is what it's saying. So it's always 2 and it's dividing by the number of years. So we are doing first year depreciation, but we will always use the factor of 40% in this problem. Okay, so what we have right now are the first year depreciation for all 3 methods. A company is only going to choose one method and stick with it, but companies can choose different methods for different classes of assets. They might use one method for buildings and one method for equipment. Whatever method they use for the financial statements, they're going to have to use the IRS tax code for taxes. And the IRS tax code is closest to double declining balance method. Not perfectly aligned with it, but for tax purposes, it's something similar to double declining balance. Now what we're going to do, that was first year depreciation. Now we're doing second year depreciation. Second year depreciation now. So going back to straight line. Straight line means the same amount every full year. So straight line we computed last time. For first year it was $7,800,000. That's how much it will be every full year. And this problem is real convenient because we bought the equipment at the first of the year, the beginning of the year, so we have a full year. We're going to do a problem coming up where we adjust for partial year. Now, units of production. Units of production in year 2, we have the $6 per mile. So we take the $6 per mile times the number of miles we flew or expect to fly in the second year. So we take the $6 times the 1,225,000 miles. So the line that I have in purple at the bottom, you take $6 per mile times the 1,225,000 miles. Another way of getting it, if you want to go through all the original numbers to start with, you take the original cost of $44,400,000 minus the $5,400,000 residual value divide by the 6,500,000 life miles times the 1,225,000. So this is not bad. You figure out the depreciation per mile and you just multiply by the number of miles you fly to get your depreciation. Depreciation is not a measure of it actually wearing out. It's an accounting measure, so it doesn't matter what, if you typically fly it by number of hours and not miles. This is just an example of a way companies can do it. We are not saying that the value of the plane is that much less. It's a methodical way to recognize the depreciation. Okay, and then finally, the last method, the double declining balance method, is I'm going to let you write that down and then I'm going to explain where the numbers are coming from, why we're doing what we're doing. With double declining balance method for the second year, what you need to do is you're going to take the original cost less all the depreciation to date. We have a name for that. It's called accumulated depreciation, but we'll get to that in a minute. But for right now, for our calculation, we're taking the original cost less the depreciation we've taken to date. The $17,760,000 is the depreciation that we calculated for year one under double declining balance. So we take our original cost less the depreciation, all the depreciation we've taken to date, which is just 1 year so far, and then multiply by that same factor of 40% that we use. So we get $10,656,000 as the depreciation for under double declining balance. These methods will normally have different amounts of depreciation. In the first year, double declining balance method will always produce more depreciation expense than straight line. Units of production we cannot make any prediction about because units of production is based on the usage, and if you used it a lot, you're going to take more depreciation. And notice, when we're talking about if we use it a lot, if we fly a lot of miles on it, we're not saying the value corresponds, that we don't have a decrease in value. It's simply a way to allocate the accounting cost over it. Okay, now we're not done with the problem. We're done with part one. So we've done first year depreciation and second year depreciation for all three methods. Now for part two, it says to show the airplane's book value at the end of the first year under each depreciation method. And book value is a really important term for us. So I'm putting the definition up of book value or the formula. This is a really important one. I'm going to take my original cost minus the accumulated depreciation equals book value. I'm going to address the question. Yeah. The question's about the 40%. In the double declining balance method, we use 40%. We calculate 40%. 40% is our factor for double declining balance method. It does not change. It is always going to be 2 divided by the useful life. So in this problem, we got 40% because it was 2 divided by 5. So that's 40% that will not change no matter what. So we will always use a rate of 40% every year. That doesn't vary. Okay. So there's that. Okay. Now, so original cost less accumulated depreciation. Accumulated depreciation, you want to make a note of that. That is a contra asset. Accumulated depreciation is a contra asset, and it's a running total of all the depreciation to date. So it's all the depreciation from year 1 plus year 2, depends how far we go, but it's a running total of all the depreciation to date. So if we ever want to know the book value of a piece of equipment, it's original cost less accumulated depreciation equals book value. Book value has 0 relationship to the asset's market value. Can you close that? Okay. The book value has no relationship to market value. This is simply an accounting number. Okay. Now what we're going to do is calculate the book value under each of these 3 methods at the end of the first year. So they ask us. So what we're going to do is we have the cost, we have the accumulated depreciation, and this is at the end of the first year. So this is requirement 2, end of first year. The book value is going to be the cost less the accumulated depreciation, and we get book value. Straight line depreciation, after 1 year, the book value is $36,600,000. Under units of production, we're going to see $40,050,000, and then double declining balance, $26,640,000. I'm going to pause for a minute, and then I want to talk about briefly why people would choose different methods. Companies have a choice of which method they choose. They can use straight line, units of production, double declining balance. A great many companies will use straight line for their financial statements because straight line's easy, it's intuitive, it seems to make sense. We just divide by the number of years, basically. Units of production can be used for a very, very, very narrow set of assets, so it's not used as much. But double declining balance method, companies can also use that, and companies on taxes can have this choice between straight line and double declining balance. The advantage to using double declining balance is you're going to get a much bigger tax deduction in the early years using double declining balance method versus straight line. So a company would have an incentive to use that's called an accelerated method. Double declining balance method is an accelerated method. And companies, everything else being equal, would rather have a tax deduction early in the life of an asset than later. All 3 assets will produce exactly the same amount of depreciation over the life of the asset. So in this case, every one of these methods, if you add up all 5 years, they will equal exactly the same amount of expense. However, how they allocate it to years differs. Double declining balance method will put much more in the early years, giving companies a bigger tax deduction, which allows them to invest the money somewhere else to earn it. We would, all other things being equal, we would prefer to have our money now than later. Now, there was a question about, is this legal? Yes, absolutely. We have financial statements. We have generally accepted accounting principles that say, here are the depreciation methods you can use, and we use straight line or whatever method we choose. We disclose that in our financial statements. Most companies use straight line. And then for taxes, the tax code says, here are the methods you can use on your tax return. Remember that your tax return is not a financial statement. Your tax return is a government report, a report to the government calculating how much you owe them. So companies can and should minimize their taxes. They have a responsibility to minimize their taxes through legal means. And this is one way, by using the accelerated depreciation method. So we're not going to get too much further into why you would pick one over the other, but know that they are different and they have different reasons for using them. Okay, that said, now we'll put that question to bed, And now we're going to go to the questions you have. So this is slides 9, and we're going to do 9 and 10. So right now we're going to take a pause for a couple of minutes. We did one of these in the video that you would have watched for Sunday night. So go ahead and try this one and see if you come up with the answer. And we're going to pause for a minute or two, and then we'll be back. So I'm going to turn off the sound for the moment. Do we have some answers clicked in yet? Do we have answers clicked in? Well, I mean, do we have a lot of answers, or am I still waiting? I'll wait another minute or two. Okay. I'm going to go through this one now. The answer is B. It's 168,132. And how you do that, I'm going to put up the calculation. Going to wait a minute while you write it down, and then I will talk through it. So it's going to appear momentarily. And again, I'll walk through it in just a moment. How you do this one, it's kind of a three-step process. First thing, well, the problem here is that we buy the building, the land, and equipment all for $850,000, and that's common because especially if you buy a house, you have to buy the land that goes with it. You don't negotiate two purchases. You don't have a land purchase and a building purchase. So in this case, we have land, building, equipment we bought for $850,000. Now, the market value of the assets adds up to more than $850,000, and that's fine because they'll give you some money off if you bundle the equipment in and you get a deal. So the market values of the equipment and the land and the building is $910,000. So that's the $250 plus the $480 plus the $180. So that all equals $910. Now we're interested in the equipment. The equipment market value is $180. So we're saying what percentage of the total market value is equipment? Well, equipment is 180 divided by 910, which is 19.78% approximately. So 19.78% of the purchase price then should be allocated to equipment. So that's how we take the purchase price times the 19.78%. I would know how to do this kind of things. These are pretty easy once you get the hang of it, and I would put it on my reference sheet. Okay. Now we have one more question, and then we'll do another homework problem. So the next question says, here's land that we purchased. We have back taxes paid by the purchaser of $8,500, total cost to demolish and clear the land, and cost of paving the parking lot. What's the cost of land? So how much is, and the reason we're really concerned with how much the land costs is we cannot depreciate land. So land goes in this account and never changes. You're basically asking yourself, there's giving you four numbers, which of those four numbers do you add up to get the cost of the land. Yes, I believe so. Do you have answers? Okay. Well, tell me what you do have. Okay, so we have a bunch of C's, and the answer is C. C means that we're going to get the cost of the land. We're going to take the purchase price of the land plus back taxes plus cost to clear the land of $215. The cost that is not included is paving the parking lot. Paving the parking lot is a land improvement. We get to depreciate that. Now on to another homework problem. This next homework problem is short exercise 7-6. It's in your book, not in the handout. So this is a normal homework problem. This is nice because we get to try the methods again, and this one has a partial year, so we can see how we have to deal with a partial year. We have, on this one it says, assume on September 30th, 2011, they purchased an aircraft at a cost of 41 million euros, and they expect the plane to be useful for 5 years or 5,200,000 miles and have a residual value of 5.2 million. They will fly the plane 390,000 miles during the remainder of 2011. Notice that we're looking at December 31st, 2011. The purchase date was September 30th. So we had this plane in 2011 for 3 months. We always do depreciation to the closest month, whole month. We're not doing days or anything. You don't do depreciation by days. So the nearest whole month, something to note, it's 3 months. So we're going to have to adjust some of our depreciation figures to reflect that it's only 3 months out of the year. We are going to compute depreciation for that first partial year for straight line, units of production, and double declining balance methods. So starting with straight line. Straight lines are our easiest method. Remember, straight line, we're taking our cost. Our cost is 41 million euros, less a residual value of 5,200,000, divided by the 5-year life, and then multiply it by the year adjustment. So I'm going to put this up, let you write it down, and then I'll come back to the 3/12. The first line of that circled item, the 41 million minus the 5,200,000, that's our residual value, or 41 million minus the 5.2 million residual value gives us the depreciable value. Divide by 5 years, that's what we did before, but now we need to multiply it by the amount of the year that that we own it. We own it for 3 months out of 12, so 3/12. If you just always want to stick that in there, it'll work for full year as well. And you say, well, full year, it would be 12 over 12. So our depreciation for straight line is going to be 1,790,000 for the first year. Moving on to units of production then. Units of production, what we're going to do here is we are going to take, we're going to calculate our depreciation cost per mile. Our depreciation cost per mile is the $6.88. How I got that? 41 million minus 5,200,000 divided by 5,200,000 miles. I'm going to wait, let you write it down, and then we'll talk through all those numbers. With units of production, we're getting a depreciation amount per mile, per pound, per foot. Some measure of depreciation usage. So we get the 41 million original cost less our residual value divided by the total life in miles times the number of miles we flew. Now this one, there is some depreciation. If you do that first calculation, you will get 2,685,000. If you round the cost per mile off to $6.88, then you will get 2,683,200. Either one of them is acceptable here. When you're doing your homework, just watch the instructions in My Accounting Lab. It'll tell you how to round. Units of production does not need to be adjusted for the partial year because it tells you exactly how many miles they flew, so that's already adjusted. That's 390,000 miles is not for the whole year. It's only for October, November, and December. So you don't have to adjust units of production for a partial year. And then that brings us to the double declining balance method. Double declining balance method. Again, I'm going to have it pop up, and I'll wait, and then I'll talk through it. Double declining balance method, you always take the original cost, which is the 41 million, times the factor. The factor is always going to be 2 divided by the number of years in the life. So we take 2/5, and then we multiply by the partial year, and here we have 3 months out of 12. So we do have to adjust that one as well. We're done with the calculations for this problem, but there are 2 questions that we still have to answer. The first question says, which method would produce the highest net income for 2011? The method that produces the highest net income is the one that has the lowest depreciation. And the lowest depreciation in this case is going to be straight line. Straight line will always be lower than double declining balance in the first year. So straight line is going to be the lowest. And then the second question is, which method produces the lowest net income? The method that produces the lowest income is the method that has the highest depreciation, which is double declining balance method. So the highest net income, or the lowest net income would come from the highest expense. Straight line will always be lower than double declining balance in the first year. We cannot make any prediction about units of production because it is a function of how much of that measure that we use. So we cannot predict upfront. That's it on that homework problem. So we're going to do a few questions, I believe. Next up. Let me see your next question here. The next question is a duplicate, so we're going to skip it, and we're going to skip to, yes, so that's a duplicate. We're skipping to slide 12. These questions are good. I have a lot of different questions like here because I want to show you what's important to watch for when you're looking at these. So this one on slide 12, January 2nd, 2011. So it's good to note the date. So it's the beginning of the year, and it's 2011. KGA Corporation acquired equipment for $260,000. So they bought something for $260,000. Estimated life of the equipment is 5 years or 40,000 hours. Estimated residual value $20,000. Okay, Now, they're asking us the balance in accumulated depreciation. So accumulated depreciation is important. I would underline it to keep my eye on the goal there. On December 31st, 2012, 12 is important because look at when we bought this. We bought this January 2nd, 2011. So we're talking about depreciation after 2 years. We've got all of 2011 and we've got all of 2012. Now, back to accumulated depreciation. Accumulated depreciation in this is a contra asset. So what it is, it's a running total of all our depreciation to date. So in this case, okay, we need to first of all calculate our straight line depreciation. Our straight line depreciation is going to be the cost of $260,000 minus the residual value or salvage value of $20,000 divided by 5 years. So what we will get is $48,000 of depreciation expense per year. So the $260,000 divided by 20,000, or minus 20,000 divided by 5 years gives you $48,000 of depreciation expense per year. That's not the answer. Back to what you underlined. It's looking for the balance of accumulated depreciation. Accumulated depreciation is a running total of all our depreciation to date. So what we're going to do is this is 2 years. We got it January 2nd, 2011. We're talking about December 31st, 2012. So 2 years of $48,000 a year. Straight line says same amount of depreciation every year. So our accumulated depreciation after 2 years is going to be $96,000. That's our $48,000 per year times the 2 years. So the answer for this one is going to be $96,000. Okay. Okay, next question up. We're going to do a few more before we're done for today. Yes, and look at the really small writing. Yes. Okay. Now, another one. Same company. But this one, the reason we're doing this one is we want to look at practice reading what it's looking for. Same set of circumstances. January 2nd, 2011, we acquired equipment for $260,000. Estimated life 5 years. Estimated residual value $20,000. What's the book value of the asset on December 31st, 2012 if they use the straight line method? So things to note. This is 2 years worth, right? So January 2011 to December 31st, 2012. They used the straight line method, which is good news for us, but they're asking for the book value. Book value, you took notes on it earlier, but book value is going to be the original cost less the accumulated depreciation. So the original cost less the accumulated depreciation. So what we'll see here is we have $48,000 depreciation expense per year. We did that in the last, what you're seeing so far is the answer from the last one. But what we do with this one to get our book value is we take that accumulated depreciation, the $96,000, because remember, this is the answer for the last one. We're going to take the $96,000 away from the original cost. Original cost is $260,000 minus the accumulated depreciation of $96,000, which we got in the last question, gives us a book value of $164,000. So the answer is D. I can't read that by the way. Okay. Okay, we're going to do another question here coming up. And this one, again, we'll be reading what they're asking for. This next one is slide 14. This company acquired equipment for $230,000. The estimated life of the equipment is 5 years. Estimated residual value is $30,000. And it's asking us the book value of the equipment if they use the double declining balance method. So there's lots of things that I find important in that problem. First of all, we're talking about 1 year because we purchased January 2nd, 2012 to December 31st, 2012. So it's good to see how many years you're talking about. You're talking about 1 year. They're looking for the book value. Remember, book value is original cost less accumulated depreciation. Since it's the first year, it'll be less our depreciation. And they're using double declining balance method. So first thing I'm going to do is I'm going to calculate my factor for the double declining balance method. So my factor is always going to be 2 divided by the number of years of life. So 2 divided by, this is another one for 5 years. So 2 divided by 40%. I'm going to take that rate of 40% times the book value. The book value of my equipment right now in that first year is the $230,000. So I'll take 40% times $230,000 gives me $92,000 as my depreciation. I'm not done with the problem yet though. That's my depreciation for the year. It's not asking me the depreciation for the year, it's asking me the book value at the end of the year. What I'm going to do to get my book value is I'm going to take my cost minus my accumulated depreciation. In the first year, that is my total depreciation. So I take the $230,000 cost less the depreciation of $92,000, and I get $138,000 as my answer. $138,000B is the book value of this equipment. Okay, and then that brings me to the end of what I want to do today. Remember, on Thursday, we're going to be finishing most of the rest of these questions. If you want to get a head start, you might want to take a look at the questions, see if you can answer them. But Thursday is going to be a lot of rapid fire questions. We have a lot of questions, and I think those are good review tools. So remember to check on Blackboard under announcements for the tutoring sign-up, and I will see you on Thursday.